Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Jack Crooks is president of Black Swan Capital. He is a currency trader and investment advisor. He publishes Black Swan Currency Currents. It's a free global macro and market newsletter, and a good one, too. You can find him online at blackswantrading.com. He's with us today from Palm City, Florida. Hey, Jack, welcome back to This Week in Money.
Hey, Phil. Thanks for having me again. I appreciate it.
Good to have you here, and we've got a big headline for us today from Europe. That German Constitutional Court saying it's okay for Germany to ratify the ECB's bond buying program. That's the one where they're going to buy any and all Eurozone government bonds that are still lying around, and that's driving the euro higher. It's up to $1.29 today.
Yeah, it's been very good for the euro. The news on the German court, no surprise. I think most people expected them to okay the bailout mechanisms that were created. They had some concerns about committing Germany completely to this, so there were some caveats. But in general, people are very excited about what's going on in the euro, the last week's announcement and today's.
I guess the biggest caveat, of course, is that the court set a cap on what Germany's liability will be, and it sounds like a huge number here, $245 billion. That's they can't spend more than that without approval from the German parliament.
Yeah, it is interesting because I think most people look at that and say, well, it's free reign here. The euro is saved once again. Yeah. But in the background, the reality is even that kind of money, if Spain and Italy, jointly get into trouble, it's not going to be enough, really, if we see another massive crisis. But we're hoping, or at least the thought is that won't happen. I think the real underlying kind of surprise, I think, for most people will be that we haven't seen the approval of this kind of new austerity measures go through the parliaments of either Spain or Italy, and I think that's going to have to happen. And so I don't think you're going to see a heavy type of bond buying that most people expect for both those countries until they commit to new austerity, and they're kind of fighting it. And that probably won't happen until sometime in 2013. So there's a lot of politics that go under the bridge between now and next year in all these countries, and especially Germany with Merkel up for election next year. So I think this crisis is far from over, to tell you the truth.
Jack, you're pointing out in the latest Black Swan Currency Currents a core problem here at the heart of the euro that we probably are not aware of here in North America, that the weaker countries in the Eurozone can't compete against Germany when they're all using the same currency.
It's always been the problem. And originally they set the system up such that these various countries could borrow at German interest rates for many, many years, and they did. They borrowed money at relatively even in terms of what looked like risk as Germany would have it for many, many years, and they were supposed to use that money, these periphery countries, to make themselves more competitive and increase their labor flexibility, et cetera, et cetera. But the reality is they've gotten less competitive against Germany over the years, and now they're at a situation in which Germany continues to pull away. So there's no way these countries can create the wealth needed if they have to compete against Germany, and I say that as the core problem, and it is. Ultimately, wealth must be created. All this stuff is financial engineering to cover up what's really is a banking crisis, but they haven't solved the other crisis, which really is the core of the structural problem, which is the competitive crisis, and this lingers on. And the only way this can be resolved is if these countries decide that they want to spend decades of just having adjustments to their labor markets, which takes a long time. Obviously, when I say decades, maybe a decade or more. Or Germany can decide to reduce its relative competitiveness and change its model and start inflating internally and those types of things. I doubt Germany is going to do the latter, and I doubt these countries, taxpayers and citizens of these other countries are going to allow for a decade or more of deflation in their own countries. So that's why I say I still think there's plenty of crisis ahead here for us.
Jack Crooks here on This Week in Money, and the market's obviously trading higher on the European news. Great headline at Forbes this morning, Jack. Is the rally over? German court ruling in Bernanke the final catalyst. What happens when the Europhoria dies down, probably in a couple of minutes from now?
I've honestly been quite surprised how far this euphoria has run. But you're exactly right. The implication is, buy the rumor, sell the news, and the news seems to be all the good news is out for a while on the euro, i.e. the ECB, their final kind of effort, so to speak, of saving the euro or keeping the euro viable is now in the marketplace. And now if we have to start seeing the euro trade on its relative fundamentals, it could start to weaken. At least that's my view, and so I tend to agree with your presentation there.
Flip side of the euro, the U.S. dollar. The dollar index below 80 today as the dollar hits a 4-month low. And obviously now the focus will shift to the FOMC meeting, and that's coming up this week as well.
Yeah, I have a big one, biggie, FOMC, and if the market is surprised, the euro will tend, I think, to pull back, and I think it'll market surprise, meaning if they don't get the QE3 and the extension of zero interest rates as far as the eye can see type of thing, and the market, i.e. sells off, the stocks sell off, that risk aversion, I think, will be beneficial for the dollar. The dollar will tend to get a risk bid, and I think you'll see the euro come back. And that dollar index, I think, will start to pop back up. When you look at the dollar index from a technical standpoint, a lot of technical factors make it look like it's oversold here and due for at least a bounce. And who knows, maybe the FOMC delivers that.
Now, we are recording this before the FOMC meeting, and it's going to be broadcast after, but I guess we can look ahead to what's going on. A lot of people here are characterizing Bernanke as dovish, that are not going to come out with anything strong. Basically, they're going to be a lot of talk, and they'll extend their zero interest rate policy a couple more years, but no announcement of a huge infusion of capital.
Yeah, I think that's right. But I do definitely think the market is looking for, as you say, a very, very dovish talk in here. And basically just a hint that QE3 is on the way. And if they don't get that, I think we could see some type of sell-off.
We've got to obviously look at the jobs data, and that's what they're thinking about at the Fed today, that August jobs data. Kind of disappointing. Here again, Forbes, jobs report looked bad, but was it QE3 bad?
That's a great question, and that is the big question. And it was another weak report, and I think it surprised a lot of economists. The reality is the small business and the medium-sized businesses just still aren't getting aren't creating the jobs that are needed. Obviously, for us to continue to grow, U.S. when I say us, and I think that it's only a matter of time because there's a lot of cash on the sidelines. But these companies really are unsure about the future, and they just don't have the clarity in here. And then I think until we get some real clarity, and I'm not sure if another round of QE provides the clarity or shows that we're in more desperation mode again. But until we get that clarity for the small and medium-sized business and some money flowing to them, instead of being stuck in the banking system, so to speak, I don't think we're going to see a vibrant job market at all, and so that's what we're watching. We have to see some confidence from the small guy before we get a decent rebound. We think a real viable bounce in the job market.
Jack, what about the effect on stock markets if Bernanke doesn't do anything more than talk?
Yeah, I mean, the stock markets, as you know, Phil, are just been running on juice every time the ECB makes another pronouncement like this. Their long-term refinancing operations last year coincided with Bernanke's loose talk. It just juices markets. The reality is, though, if you look at the earnings outlook for U.S. corporations, primarily what I'm speaking of here is the U.S. market's driving. It seems to be the driver here, doing so well. Over 50% of earnings come from international operations for U.S. multinationals, and you have China is I think growing a lot slower than people realize. We know the Eurozone is going deeper in a recession, so on the pure fundamentals and earnings, they're just not there. So that's why I think if the juice isn't there from liquidity, we could see a very big move in the stock market to the downside.
We're talking to Jack Crooks from BlackSwanTrading.com here on This Week in Money, and for folks who've been predicting all year long the end of the greenback as the reserve currency, I hate to disappoint you, but it's not going to happen yet, is it?
We just don't see it.
Yeah.
In fact, we've said for a long time that we think a multi-year bull market in the dollar started back, 2008, in the midst of the credit crunch, and we stick to that. there is no replacement on the horizon. And to us, once as you just talked about, any minute here, the effects of the last ECB move out of the way, we think the euro starts to fade, and when it does, the dollar tends to be the flip side of the euro. It's the only other currency out there. So we think the dollar does well in here going forward once we get past this euro euphoria.
Jack, what about the other news this week? Moody's saying the U.S. could lose its AAA debt rating if those negotiations don't fix the debt problem. Yeah, how much credence do you lend to that?
First blush you go, well, it's kind of meaningless, but you really have to think about it longer term. It is a serious problem, and I do think Moody's makes a great point, and a point that a lot of people think about. I just don't see an attack on the U.S. bond market at the moment. I think they still got their guns turned at Europe and the situation there. But I do think if the U.S. doesn't get its house in order very, very soon, this concern about the U.S. bonds starts to make a lot of sense. Some type of attack on the U.S. bond market, but I do think we're a couple years away from that. Once we get through this cycle and no improvements made, I do think it's a very serious situation.
Jack, what about some of the other currencies? The yen, the U.S. dollar recovering nicely against the yen, not entirely euro-driven. The cross breaking around 78 this week.
Yeah, it's funny. Some of the currencies out there that the yen used to be moving very much in tune. If stock markets were doing well, the yen would weaken. But of late, just recently, the yen has strengthened against the U.S. dollar in here, and it could be an indication that there is some more money still moving into safe havens, despite the fact that this market keeps inching higher and higher in here. The yen's an important currency, I think, to watch. I do think we're going to get the yen is actually going to strengthen more, especially if we get a pullback in stock markets. But I do think from a longer-term standpoint, the yen will be defended in here somewhere around 75 level against the U.S. dollar. And I do think long-term the yen is really a currency that will weaken over time because, you just talked about Moody's and their warning against the U.S. I do think we could see a bond market crisis in Japan first and then turn to the U.S. And if we do see a crisis in the Japanese bond market, I do think that's the time the yen will finally start to weaken in a very big way.
We're talking to Jack Crooks on This Week in Money. Jack, what about the Aussie dollar? It's benefiting a little from the dollar weakness, $1.05 for the first time in 3 weeks.
Yeah, it's benefited greatly, and tell you the truth, given what's going on in Asia and the growth slowdown in China, it's been a bit surprising to me. I never thought it would rally back to this level. I think longer term that it still has a very big growth premium in relative to its position vis-a-vis China. But with the slowdown in China, I do think longer term the Aussie has to have some of that premium squeezed out of it here. No doubt, though, people look at it as kind of another safe haven, Australia and Canada, too, relative to the U.S. and Europe. So it gets some of that money flow there, regardless of what's happening in the fundamental economy. So it's benefiting from that side. But as I said, once we get through this euro euphoria, I do think the Aussie will pull back and has to pull back in here and shake out some of this growth premium relative to China.
Got to look at the Canadian dollar, too. It is lower this week after hitting a 13-month high earlier, mostly on talk of QE3. Where are we headed with the Canadian dollar, Jack?
Canadian dollar, again, has been a lot stronger than expected. It just keeps ratcheting higher against the U.S. dollar in here, and I do think it is getting that haven flow relative to the U.S. We just talked about the bond concern, in the U.S., and all the monetary games going on with Bernanke and QE. So the Canadian dollar has been looking very, very good in here. It too, though, ultimately will feel the pressure if people start to act on the slowdown in China. But in terms of the commodity currencies, it is my favorite, even relative to the Aussie. I think a nice trade going forward for Canadian investors, might be, stay long Canada and short it against the Australian dollar. I do think the Aussie's way overvalued against the Canadian dollar in here. But I I think we're getting close to some type of longer-term bottom against the U.S. dollar, CAD, just from a technical standpoint.
Jack, you are headed to Las Vegas this week, the Forex and Options Expo in Las Vegas, and you got an interesting topic here, Germany's strategy and how that's going to change the outlook for the U.S. dollar. Can you give us just a quick sneak preview?
Sure. I'm going to talk about just kind of Germany's overall grand strategy here, a little bit political, obviously economic, and why I think it's going to fail ultimately, given what's going on in the global economy. Mm-hmm. Germany has certain expectations, and one of their expectations is to be the world dominant exporter. I don't think people know this, but Germany is more dependent on exports than any other country in the world, even more so than China. And in this environment, going forward, I think there's been a secular change in the global economy, and I think that's going to throw a real monkey wrench into Germany's plans, and I'm going to talk about that in the euro in particular.
Jack Crooks is president of Black Swan Capital. He publishes Black Swan Currency Currents, and you can find him online at blackswantrading.com. Hey, Jack, it's always good to talk to you. Thank you, sir.
Thanks, Phil, for the time. I appreciate it. Take care.
This Week in Money is archived online at talkdigitalnetwork.com.
It is good to have Mike Mish Shedlock back with us. You'll find Mish at globaleconomicanalysis.blogspot.com. Mish, welcome back to This Week in Money.
Hey, always a pleasure to be on with you.
QE3, now official, the third part of the trilogy. They're calling it a significant shift in monetary policy. A couple of my favorite headlines here, Mish. Fed bets big in new push to rescue U.S. economy. Fed's new brand of QE to deliver the right message. And as always, I want to thank you for articulating the simple truth with a Mish headline, Fed in a panic state over jobs.
That's what it's all about here, isn't it?
Yeah.
Actually, I didn't predict this. I got this wrong. I knew the Fed was going to panic at some point. Anyone in their right mind knew that. The question is when. And I actually thought, and I discussed this with Chris Martinson yesterday in a podcast with Chris. He's a good friend of mine. And both of us thought that Bernanke was not going to do it, not going to pull the trigger this big this month. Now, everyone knew he was going to do something. But, man, he came out blazing with bazookas from both pockets. I mean, shades of Hank Paulson. This guy had a bazooka everywhere.
Yeah.
So, they did a whole number of things here that I think caught some people, by surprise, including me. But the question is why, and I'm quite certain I've got the finger on the handle of that. But first, let's talk about what they did. The Fed said that they're going to increase mortgage-backed securities, $40 billion a month. They're going to extend Operation Twist. They're going to increase long-term securities by $85 billion a month through December. They're going to keep the target range of the Fed funds all the way through mid-2015. So, this has me asking, what's next?
QE4.
What are we going to do? How can you start QE4 before we've seen the end of QE3? But I'm going to tell you right now in two simple words, one word, what's happening, and the word is panic. In the last 2 months, by the household survey, and for Canadian and U.S. listeners who might not know, the unemployment number comes out from the household survey. The establishment number said, well, we created 96,000 jobs, something like that. But the household survey said that in the last 2 months, employment in the United States fell. That's dropped by 314,000.
Wow.
In the last 2 months, the labor force fell by 518,000. Those not in the labor force, that is, those we're not counting as being unemployed, rose by an amazing 929,000. What do you think about that?
Good God.
Good God.
Yeah.
That's exactly what I think the Fed was saying today when they pulled out these bazookas blazing.
Now, you say this is nothing short of a certified disaster. That's got to have Bernanke spooked.
That is it. In fact, that's the disaster. I still didn't think they would pull the trigger, but if they were looking for something from which to pull the trigger, that was it. Of course, I can offer you another sarcastic opinion here. A guy by the name of Fed Watcher, who posts frequently on my blog, he came flat out and said, he did a 2-line post. He said, and I don't know if you saw this, but Mitt Romney, came out and said, Mitt Romney to Bernanke, I'm going to replace you if I'm elected president. And today we saw the response. This is what FedWatcher said. This was Bernanke to Mitt Romney. Well, you're not going to be elected in the first place. We're going to see to that.
We're talking to Mike Mish Shedlock here on This Week in Money. We've already heard what the markets did. The Dow up 200 points. Here in Canada, around the world, markets up. What about gold and silver? What did they do? How did they react to Bernanke's
gold was kind of interesting here. There was a $40 plunge on the announcement.
Okay.
And I'm still scratching my head over that. But this is classic, running all of the stops, reversing, buying in, and then blowing in long by, all the traders. Now, is this manipulation? Of course it is. Of course it's manipulation. However, it's not an attempt to suppress the price of gold. It's an attempt to cash in on whatever movement there is of the day. So, if one thinks this was about suppressing gold, I would point out that gold was, soared $75 after they squashed it $40. So, I think they cleared the stops in one direction and reversed it in another direction, and we often see that kind of behavior on big news days. And it's in both directions. It's not only gold, but the stock markets, the dollar, everything. They run the stops and then reverse the thing. I've seen it quite happen a lot. I used to trade Euro-dollar futures, and they've done the same thing with Euro-dollars. So to think that this is particularly something to squash the dollar, no, this is just blatant manipulation all around, that's all.
Mish, you're one of the few people pointing out that Bernanke not only spooked by the jobs numbers, but also by something that a lot of people aren't even aware of yet, and that is the fact that we are in the beginning of a worldwide recession here.
Absolutely. We're absolutely, with no doubt about it, we're in a recession. I'm not the only one that thinks that. John Hussman made a statement on that fact the other day. He thinks that the U.S. entered recession in June. I made the same statement, actually, a few days before he did. Actually, it was on the job number. Someone had asked me the U.S. ISM number last week came in better than expected. I'm talking about the services ISM. All the manufacturing ISM and all the regional Fed surveys have generally been pretty bad, actually, for a couple of months. So all of a sudden we get the services ISM that's pretty hot. Someone asked me if that changed my opinion, and I said, okay, give me one more day and I'll tell you. And because the next day there was a jobs report, and I saw the jobs report and I commented on it. I said, no, I think that services ISM is either an outlier or there's actually something wrong with it. The numbers are going to be revised down, something. But my gosh, Germany's in recession. Spain and Italy are in horrendous recessions. Australia is in recession. And dare say it, I think Canada is probably there too.
Let's talk a little bit more about that in a second, but I also want to back up for a second and talk about China. What's going on in China, and why should we here be in Canada and in Australia be worried about what's going on?
Canada and Australia and Brazil, actually, far more than the United States. Actually, the U.S. is probably a beneficiary, actually, of a collapse in China. The price of steel is down over, I think, something over 50%, I believe. And Mike Pettis at China Financial Markets thinks it's going to collapse another 50%. All the exporters to China are suffering. Australia certainly over steel, over copper, over coal, over things like that. China is slowing. And what happened? All these people just thought that this growth, that China could keep growing at 10% a year. Well, most of the growth was actually just fraud. There were Ponzi lending schemes. These things are imploding now. I talked about it on my blog. I did a post, China shadow banking system collapses. But there's been a number of stories out that over the months, but over the past few months. But I think we've reached critical mass on that story now. There's actually capital flight out of China. Hedge funds and hot money was flowing into China Now we're seeing the reverse of that. It's actually exiting. People are committing suicide. All kinds of problems. It's really a collapse of the shadow banking system. All of these people that thought that these developments could keep going on over there, they're building entire cities, entire malls, everything where no one lived, no one shopped, trains that no one used.
Yeah.
I mean, how long can you keep growing under that kind of model? Well, it ended.
We're talking to Mike Mish Shedlock here on This Week in Money. Next, Canada. A great post this week. You were talking about Canadian exports collapsing, and you're saying, hey, folks, expect a big plunge in GDP.
Well, I think this caught everyone by surprise, at least most of the Canadian readers. This did not catch me by surprise. Actually, I knew that this was going to happen at some point. Whether I would have predicted it exactly this month, I don't know. But people were, pretty much astounded. Virtually all Canadian exports collapsed. Energy, autos, agriculture, forest products, machinery, equipment, everything. Globally, 3.4%, 5% drop to the United States. Now, let's think about that. We've already talked about China, but U.S. is Canada's largest trading partner. So if the U.S. needs less of these Canadian products here to produce machinery, parts, what little manufacturing, whatever we do here in the United States, what does that say here? I think this is another piece of the puzzle that suggests actually the U.S. went into recession, and the U.S. going into recession with China dramatically slowing is going to hit Canada extremely hard.
Let's talk about Canada's housing bubble, something you've been on top of since day one. And for all the folks who say it's different here, sorry, it's not.
Well, it's not different in Canada, but I got a taunt last week. Mish, how long have you been wrong? Blah blah blah.
Yeah.
And, you got to stand up and say, yeah, I expected Canada housing bubble to pop more than years ago, 2 years ago, 3 years ago, actually. And I said the same thing about Australia. I'm feeling better about Australia because its bubble popped about a year ago, and it's not collapsed to the same extent that the U.S. did, but it's getting there. It's picking up steam. The property bubble in China has also collapsed, and we're seeing the effects there in the stock market. My God, look at the Chinese stock market. It is absolutely collapsed. One of the worst in the world here. Outside of something like Spain or Greece. But Canada, it just kept on going, and it's like the Energizer Bunny, and people thought, well, this is it. Things are different, and this proves that Canada's different. Well, no, it just proves that things got more insane in Canada than anyone like me expected. That's what it proves. So I think, and I did this story. I said, well, maybe the bubble's about ready to pop. But I got a bunch of emails then from people from Canada saying, Mish, things around Vancouver have slowed dramatically. We're seeing huge price reductions. One person said it's not hit Toronto yet, but it's hit the rest of Canada. This person couldn't understand what's going on in Toronto. Well, I certainly can't explain that either, but apparently there's a big condo boom still going on in Toronto. But condo booms are among the most deadly of all booms because, when those things go, they really go, and we see prices plunge 60-70% when, from top to bottom when they go. So, I don't know whether that applies to Canada or not, but you know what? I really think that we're going to see prices fall in Vancouver and in places in Toronto and some of the big bubble areas. 50-60% on some of these properties, yes.
We've got some hard numbers here from our friend Garth Turner at greaterfool.ca. Sales of detached houses in Vancouver last month crashing 39% from last year. Overall, 31% fewer deals than the same period last year. The worst August since 2008. Sales in general running 39% below the 10-year average. It is not different here.
We've seen that before, and then we've seen, the sales pick back up. And I believe that's everyone's expectation this time. But what's different this time is China is collapsing and the U.S. is heading into recession, that is really going to put a damper. It's going to hit. Probably going to hit Vancouver first, and then it's going to spread like wildfire through the rest of Canada, in my opinion.
As an export-driven country, we got to be terrified by this news.
Well, I don't know whether you have to be or not.
Yeah. You should be.
You should be.
Yeah.
Well, you should be.
Mish Shedlock from globaleconomicanalysis.blogspot.com. Follow Mish on Twitter at MishGEA. And don't forget Mish's blog on your iPhone. A free app from the folks at Concentric Sky. That's available through the App Store at iTunes. Hey, Mish, it is always good to talk to you. Thank you, sir.
Hey, a pleasure to be on the show.
This Week in Money is archived online at TalkDigitalNetwork.com.
David Skarica is author of The Great Super Cycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. And you can find Dave on the internet at addictedtoprofits.net. Hey, Dave, it's good to have you back on This Week in Money.
It's great to be here.
Highlight of the week, I guess, a little open-ended stimulus from Dr. Bernanke. Even sounds scary to say it, but it's a big deal.
Yeah, I think this was a real inflection point, almost of what happened, as important as what happened in 2008, 2009 when the first round of QE started. Now, see, that first round was obviously the first round that was, stimulus and kind of bailing out the financial system. And I always said that they were in QE infinity, and that's finally has come to fruition.
Yeah.
Because I think part of what no one talks about is these deficits are so large in the United States, and something like, $7 or $8 trillion worth of debt's going to be rolled over in the next 3 years. Someone has to buy all this stuff, and, it might as well be the Fed. So that's part of the reason they're doing the money printing, is to essentially buy the debt and that they don't think there'll probably be enough demand for. And I think this is very, very key, because essentially means they're going to print to the end of time. But it's like, I guess it's kind of like Iraq. There's no real exit strategy here. It's just, let's print until things get better, and I don't think they are going to get a lot better, because I just don't think you can print your way into prosperity. So, and it also goes towards the argument that I've said that despite that you're going to be in this subpar growth for a number of years, it's not going to be deflationary. It's going to be inflationary, because the solution is always going to be print money. So we've seen that this week with what commodities did, with what gold stocks have done, with what markets have done. They're just going to try to inflate their way out of this, and that's why I cannot be a deflationist, because the solution in the end, the forces are deflationary, but the solution is always inflationary or hyperinflationary.
Let's talk, Dave, about the effect of QE3 on gold and the other precious metals. A big increase. Gold shooting 2% higher, platinum up 2%, silver up almost 4%. Are we going to continue to see more of this in a post-QE world?
Oh, yeah, I think that this is the start of the next big leg up. Like, if you look at the cycle pattern, just ignoring the news, gold stocks saw major bottoms in 2000, 2004, 2008. So there seems to be kind of a 4-year cycle, which I think we're in the trough of right now. And so I definitely think this was a key low in the gold and gold stocks. And we can see what happens off this low. Like in 2008, we saw gold stocks double in a number of months from their low. And this time around, if you look at the HUI index, you're up almost 40%, 35% from the lows in just a couple months. So now granted, those are very depressed lows. That's why you get the big jump. And if you look at gold itself, I love the gold pattern. You've got the peak last year, followed by this kind of sideways, very tight, coiled consolidation, and now we're breaking out of that consolidation. Now, on the seasonals, we tend to see a pullback sometime in October into November, and then the continuation of the breakout. And I think that's what we've essentially set ourselves up for here. But yeah, with the money printing in Europe and in the United States, I think we're going to continue to see gold and gold stocks move higher. And then after the election, no matter who wins, you're going to see the fiscal cliff push back in the States again, probably till 2013 at the earliest. And that will kind of, stave, again, more of these deflationary pressures, at least in the short to intermediate term. And then we can probably have a very good 2013 in gold and gold stocks. I think we're really getting ready for something bigger to the upside here, because, again, the monetary side of things is totally now on the precious metals side. And what I really think is going to happen longer term, so we talked about intermediate and short term, is what no one likes to think 2 or 3, kind of steps out.
Sure.
But if you look at it, that's how guys like Soros and all these big-time money makers would always make their money. No one's looking at, everyone thinks Europe is a basket case, but I'm looking at the positive side of Europe right now, where they're restructuring and modernizing their economies and doing austerity and scaling back government, all things the United States is not doing. So what I think is going to happen in about 2 to 3 years, you're going to see, that the deficits in the UK and Italy and Spain and all these places will be half or a third of what they are today due to austerity measures. The U.S. is still going to be pushing back their fiscal cliffs and do no cuts whatsoever. So then the U.S. goes from being the tallest midget to the shortest midget, and then I think that's where this QE becomes very risky. Because what happens then is you could see a big run on the dollar, because when all the other countries in the world have dealt with a lot of these fiscal issues, you'll see the U.S., I think there'll still be gridlock in the U.S. at that time. And then that's when I think the market will force the politicians' hands vis-a-vis higher interest rates at that time. I think you're going to see, and Bill Gross has talked about this, an ultra-steep yield curve where they're going to keep rates at 0, but now you're going to see a big sell-off in the coming years in the long end of the bond, and you could see, long rates go to 5, 6, 7% with still 0 on the short end.
We're talking to David Skarica here on This Week in Money. Dave, you mentioned the yield problem before, and I guess that's one of the big downsides of QE3 is that to get a decent yield in today's world, we have to take a whole lot more risk to even get some return on our portfolio.
Yeah, I think if you look at it, if you want decent yield in government bonds, you have to look at like the pig countries, which, you could argue are insolvent, or you have to look at emerging markets like India or Brazil, both which yield near double digits on their U.S. dollar-denominated bonds. So, you have to either take big risks or you just buy gold and precious metal stocks and equities or anything. And that's essentially what they're doing. That's why this will all end badly at some point, because they're misallocating capital. What's happening is they're basically telling people, we don't want you buying the government bonds and parking your money. We want you to take risks. And those risks, just like the housing bubble or the internet bubble, at some point are going to blow up in everybody's face. So it's just a question of when that happens. They've been able to kind of just kick the can down the road so far, but I think you're going to have another one of these bubbles kind of blow up in the coming years. I don't think it'll be tomorrow, but at some point it will. And I think one thing that's really helped the U.S. or them do this, for example, recently was the slowdown in Europe, because the slowdown in Europe was, again, a bit deflationary, pushed down prices of commodities for the last year or so, and it got European equities really, really cheap to the point where they were totally sold out. And actually, I would almost argue that even though everyone's talking about QE3 in the States, that a lot of this recent rally actually has to do with now Europe is pulling the States up by bouncing off its bottom. So they've kind of been lucky because they got the flight to quality from what's going on in Europe, and then they're getting the advantage of the bounce coming out of Europe as well. And the European equity markets were so cheap this past summer. I'm arguing this is a major rally in Europe. It's something that's going to last a couple years, and that, again, could just kind of help the States for the next year or two, kind of stave things off. But the problem in the States is they're like, I call it the Wile E. Coyote syndrome, where they're just kind of sitting up there in thin air, and at some point they're going to fall off that cliff. Everyone talks about the fiscal cliff.
Yes.
But the fiscal cliff is inevitable. We're Canadian, and we went through a period of austerity in Canada in the late 80s and into the mid-90s. And, the Canadian economy grew slower at the time. There were downgrades from the bond rating agencies, but Canada came out of that much stronger than the United States, and that's why they're stronger now. And they have to deal with that at some time. That's why I laugh at the whole concept of the fiscal cliff. They act like they can grow their way out of this or keep kicking the can down the road. But the only way you're going to really solve the problem is to, quote unquote, take your medicine, do the austerity like Sweden did in the 90s, like Canada in the 90s, like Spain and Italy are doing now, get a bad recession to kind of help cleanse the system, and then clean everything up and move on from there. But it doesn't seem like on both sides, it seems like they're kind of delusional on both sides of the aisle in the States that that has to happen. I think things have been so good for so long in the States, regardless of what you say, the struggles in the middle class, just on a whole, I just think that they're, they're in denial that they have to go through some period of hard times.
Dave, you got to remember what happened to the coyote after he fell off the cliff. A big rock landed on him, right?
Well, that's what's going to happen. Not only are they going to fall off the cliff, a rock is going to, land on them. I always tell people, if you look at it, okay, and there's a little more flexibility in the American economy, but really the only difference between Italy and the United States is the U.S. can print its own money. That's the only difference. Like the debt levels, all of that sort of thing is not really that much different. So I don't really see how they can avoid kind of the inevitable. And I always tell people the market at some point does take over. Like, look at Germany. Germany's not doing, or Canada, we're not doing any form of QE whatsoever, but our rates are down where the U.S. and British rates are, two countries that have done a lot of QE. So it's like they've also benefited from the flight to quality. And I think when it turns around, I don't think the Fed can stop the forces of the market. I think that, you're going to see, like the British couldn't stop George Soros from breaking them and devaluing in the early 90s. So I don't see if all of the, the bond vigilantes finally look at the States and say, hey, you're next. I don't see how, even if the Fed prints and prints and prints, I don't think they can somewhat stop that. Like, look what's going on in Europe. Okay, they've stopped the short term, but the Italian and Spanish rates are still between 5 and 6%. So they pushed them from 7 to 5. And I think the same thing will happen in the States. Like, maybe when the Fed starts another round to kind of fight those vigilantes in a few years' time, I think that's still 2, 3, 4 years off. They'll be able to, knock rates down a bit, but they'll be knocking them down from much, much, much higher levels. And I think the big difference between, say, the States and Japan, and I've put Japanese scenarios, thinking that, hey, maybe the U.S. will just have subpar growth and low interest rates for 10 years. But I think the problem is the makeup of the bond market, where Japanese bonds are over 95% held by the Japanese public, where the U.S. has over half their bonds held by foreign investors.
David Skarica is author of The Great Supercycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. You can always find Dave online at addictedtoprofits.net. Hey, Dave, thanks for this.
Thanks for having me.
Thanks to our guests, Jack Crooks, Mike Shedlock, and Dave Skarica. And thanks to you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.